All right, everyone. So I recently had a conversation with a business owner who was pretty much doing their business by themselves as a service based company. And they were looking to start expanding and bringing on team members. So they brought me in and asked if I can evaluate their financials to see if they were ready to make that next jump. So here's what we looked at. Here are the numbers. When they started their company, they progressively started to see more and more clients. And this year, they were going to be making around $80,000 in revenue. And so that $80,000, they obviously, as the only person working in that business, will not take a salary really, but anything that's profit will be considered salary for them. So if we look at the next thing, which is operating expenses, I said, hey, you want to be able to be around at least or at a minimum 50% profit. So if you're doing 80K, you should only be spending 40K and then have 40,000 left over. Now, this 50% is a recommendation. It's also, I feel like, more of a minimum than it is, towards the higher end. Why? Because if you are not running a brick and mortar, or like if you're not renting a location and you're doing everything online and you're a service-based business, then it should be even higher than 50%. Okay. If you're lower than 50% for any other reason, typically means that you're spending on things that you shouldn't be, or you might be investing into some stuff, but you really have no assets to buy or to purchase, and so you should be keeping really, really great margins, especially when you're the only person in the company. Now, so for this company, they had a few quarters with lower than 50% margins. That's because they were investing in their education to learn more sales, marketing. They were taking courses, working with coaches, those types of things. So once all said and done, we saw that the most current quarter looked like they were going to be in that back to that 50% profit, and they felt like, okay, they wanted to make that next step. They were done investing into their education and ready to bring on a team. So we looked at it and said, okay, well, what do you want to do? Because the ultimate goal as a business owner is to reclaim your time and to use your time for higher leveraged activities. And if you're seeing clients, then really your time is only as much worth as you can pay per hour for the service or for the client. Now, with them, they were seeing, a lot of clients. So I said, okay, let's try to cut back your time in half, and then you can reinvest that time into what you feel like is most important. And so what we said was, okay, so if you were to only see half the amount or have half capacity of seeing clients, then your actual revenue will go up a little bit. You'll be at about 90,000 for the year, and this is for the owner in revenue. And let's look to see what the numbers would look like if you brought someone on. Now, when you bring on your first team member, you can call them an independent contractor or W-2. Now, I'm not going to get into all the nuances between the difference between an independent contractor and a W-2, but I suggested to them that they first start with a independent contractor because it's easier to hire, it's easier to let go of if you need to, and there's a lot less rules and less pay and taxes involved with them. So from a business perspective. So overall, I said, let's start with an independent contractor. If you want to keep them after a year or 2 years, then you can switch them over to a W-2. Okay. And so we determined that, just like with any service-based company, there's going to be a ramp-up time, not only to learn the job, but to get more clients in. So you might start off really, really low, and then it'll look like that over time. So down here, you're like near zero or, a low, and then over here would be your max capacity. So if they hired them somewhere close to the beginning of the year, it would take a little bit for them to get to max. And then what would it look like once for the whole year closes out, right? A 12-month period. So we determined it would be around $110,000 that they would bring in revenue. And about half of that would have to be paid for their salary, their work. So out of that 110, 55 is going to go to pay or direct labor for short. Okay, so out of that 110, 55 goes out, 55 stays in. Okay, and that 55 in accounting terms is called gross profits. This is a very important number to learn over time because your gross profits are actually a way better indicator of where your business is at financially than revenue. In the financial circles, they say revenues for show, right? Because it's just a big number. But if a lot of your revenue that comes in goes out by what we call pass-through costs, meaning to other vendors to service whatever that thing is, or to your team, and you have almost no money left to go down through the rest of your business to pay for your operating expenses, then you're really, not that big of a company, and you just have a ton of pass-through costs. So think if you sold a good, like a toy, 50% or 60% of everything you sell goes right back to pay for the inventory that you bought to sell it. So then you're only working on really 40% margin there, which is your real true top line. So it's a very important number, gross profits. And as you get bigger, this number becomes even more important. So 55% gross profits from this. And then you also had the 90K that came in from the owner. So you add that 90K in because, again, it's passed through for the owner in this business model. So you're looking at 145K in total for gross profit. And then operating expenses, with last year they were going to do 40,000. We safely estimated that about 50,000 will be in operating expenses this year. And so you would have about 95,000 in profits for the next year if you were to hire that person to provide the direct labor. And so from a 40,000 profit to a $95,000 profit, that's over a 2x an increase in profit. So this is a fantastic move for them to make. And two, they had really healthy margins, so they were able to do it and not really hurt the business. And so overall, they're going to over double their profits next year by adding someone in. And the caveat here is that the owner, right, with the time that they get back, needs to focus on the thing that is the big constraint for the company now, which is in the sales and marketing. Because if you don't get enough leads in and through and to fill up that new person's calendar, and they're not at full capacity, then they're leaving money on the table. So the whole goal here is to increase the amount of leads that are coming through the business. So that's what the owner is going to do. And if the owner can find a really good way, a good method to increase the amount of leads, then they can keep on adding in more direct labor over time to pair with those leads and those new clients coming in. And so that's how you would grow your business to that next level. So hopefully this helps you understand what you could be doing or looking for when it comes to hiring your team members. If you have any questions or you want more details, let me know down in the comments below. Go ahead and make sure to like and subscribe and share with a friend if you found that this was useful and you think they would find it useful.